Welcome students. So in the previous class we were discussing the inventory management where we learned the concept of incremental analysis. So we had to discuss certain more cases also about the inventory management, but I thought that first of all we should discuss all the important concepts, and if the time permits later on, then we can discuss some cases also with regard to the management of different assets. So for inventory or say managing the inventory or learning how to manage inventory as a current asset, I will stop here, and first I will complete the management of all the current assets like receivables, cash and some other assets, and then we will learn about the management of current liabilities, spontaneous finance, and then the sources of working capital finance, and after that we are still having the time, then we can discuss some cases also. So one or maybe some cases on inventory or receivables I will take up at the later stage, but here at the moment I am stopping as far as the inventory management is concerned. And in nutshell you can say that the important component which we should learn, or the important part in the inventory management which we should learn, is that ultimate objective of the financial manager, maybe the financial or the operations or the production department people, should be to have optimum investment in the inventory, right. So in what way we decide the optimum investment in the inventory, that depends upon the firm, but we have to make out, we have to analyze that neither we have to pay extra carrying and handling cost, nor we have to pay the any stock out cost. So we should be able to serve all the customers needs also, we should have the amount of inventory with us also, and that way excessive amount is also not invested in the inventory, and no order is going unhonored or unmet. So that way we have to decide the optimum level of investment, right. And in any case, if we face a problem that we are losing sales because we are following a very tight inventory policy, so in that case we can think of, or we can use the incremental analysis, the concept of incremental analysis as we have seen, and then we discussed about that if there is a restriction on the working capital supply by the bank, so how to deal with that particular situation. So we have learned something about the management of inventory, and I would again say that the important technique which we should use in an environment like India, or the manufacturing environment like India, EOQ is still valid and very useful technique, and we should depend upon that for working out the optimum level or economic order quantity or economic quantity of the material which we have to maintain all the times. So I will stop here, and then now I will move forward with the next asset, or the same learning about the management of the next important current asset. So in the balance sheet of any company, the next important current asset is the accounts receivables. We have cash also, we have advance payments also, we have some other things also. So now we are going to talk about the accounts receivables, right. So when you talk about the accounts receivables, I would like to throw a light upon that in the balance sheet you might have seen that there are the different current assets, or if you see the balance sheet you will find different current assets. We have inventory on the top which we talked about at length, then we have the accounts receivables, then we have sundry debtors, then we have advance payments or advance deposits, so and then we have cash and some say short term investments also, right. So in this case in this situation you talk about accounts receivables separately given, and then you talk about the sundry debtors, you talk about the advance payments. All these are in the category of accounts receivables. Accounts receivables is a bigger term, is a broader term, and that includes sundry debtors also, that includes the advance payments also, right. So all these assets we have to learn to manage under the categories of the receivables management, because when you talk about that accounts receivables appear in the balance sheet when we sell on credit, right. This is a result of the credit sales. So when we sell on the credit, we see that accounts receivables come in the balance sheet, but that is not accounts receivable, they are called as sundry debtors, they are called as sundry debtors. So sundry debtors are the parts of the accounts receivable. So accounts receivable is a bigger term, this is accounts receivable. So accounts receivable is a bigger term, and it includes many things. and in the many things this is accounts receivable, not AC, it is AR. So credit sales give the rise to accounts receivables, but accounts receivables include many other things also, and that current asset which comes in the balance sheet or appears in the balance sheet because of the credit sales is called as the sundry debtors. Sundry debtors are also the parts of the accounts receivable. And then say for example you talk about advance payments. Advance payments. Now for example we are manufacturing such kind of the product where the raw material is very scarce, or there is a monopolistic situation in the market as far as the supply of the raw material is concerned, right. There is only one company, there are only two companies available in the market who are supplying all kind of the raw material, and all the users of that material have to depend upon those companies. So in that case we want to make sure that supply of the material is always regular, on the time, and we are not stopping the production, or we are not to stop the production simply for the want of material. So for that reason we make the advance payments. So when you make the advance payments, in that case what happens, we are again creating the accounts receivable. Any kind of advance payment, whether we are making to the suppliers of material, whether we are making it to the employees of the company, for example somebody is has got the advance salaries from the company because of certain reasons. So in that case that is also accounts receivable, right. So we have this productive distribution system like this. Accounts receivables come appear from this side, and the advance payments generate the accounts receivables from this side, right. So it means when we are making the payment to supplier here, we have to recover that payment from the supplier by receiving the material from the supplier at the later date. And when you are supplying the material, the finished goods to the distributors here, so we have to, that these goods are given to the distributors on the credit. So we again have to recover the price of those goods also. So it means in both the cases, both the sides, accounts receivables are being generated, or they are coming up, or they are appearing, and finally they come to the balance sheet. We call it as accounts receivable, we call it as sundry debtors, we call it as advance payments. So all kind of these assets or these payments or these transactions or the accounts appearing in the balance sheets are covered under the one category, that is called as the accounts receivable. So it means out of the total accounts receivables, total accounts receivable in Indian situation, say about 50% of the accounts receivables is because of the sundry debtors. So for example, if all the things are given in the balance sheet, all the things are given in the balance sheet, say for example we have a balance sheet here, this is the balance sheet, and this is the lower part, we have inventory here, and then we have accounts receivables, then we have sundry debtors, then we have advance payments, right. All these are the current assets. So we have inventory here, right. This is the first asset, we have talked about this asset at length. Next thing is the accounts receivable, right. And for example accounts receivables amount given here is say 100. In this balance sheet the accounts receivable amount given is 100, and in this case if you talk about then sundry debtors amount is again 100, right, and advance payments amount is 20. So if these figures are given in the balance sheets, so if you have to cover only under this one head, that is accounts receivables, so how much you would show this, you will add it up 100 plus 20, and this will become how much, this will be the total amount. We will remove this will not appear in the balance sheet now, individually they will not appear in the balance sheet. So this total amount will become 220, right. Out of 220, 100 is the sundry debtors and 20 is the advance payments, and remaining 100 is the accounts receivable. So why we show these all current assets not under one head, that is accounts receivable, but we show it under the different heads, say accounts receivable, because if you show it in the accounts receivable it will become 220. But we are showing here, we are first what we are doing is that in the accounts receivable sundry debtors amount is quite large. Similarly, advance payments is also another important current asset, and that is also a significant amount if it is a significant amount. So it means it is better to show it individually in the balance sheet rather than clubbing it under one head of accounts receivable. They all are accounts receivable, but you have to say segregate them because their magnitude is quite high. So here that we are showing here is that sundry debtor is 100 and it is the 20 is the advance deposits, because if you give only accounts receivable in the balance sheet, right, and when the firm has to go out in search of or for say generating the working capital finance or maybe having the short term loans or maybe the cash credit limit from the banks have to analyze the balance sheet of the company, past 3 years balance sheets of the company. So if it is not given clearly that what constitutes accounts receivables, in that case bank won't be able to find out the quantum of credit sales. Bank won't be able to find out the quantum of the credit sales, and finding out the quantum of credit sales is very, very important. Finding out the quantum of the credit sales is very, very important. Similarly, bank won't be able to find out how much payments you are making as advance to the suppliers of raw material, because you deal with such kind of the product or such kind of the industry where the making of the payment, advance payment is required. So that may be a vulnerable situation sometimes, that if we didn't make the advance payment, company will not get or firm will not get the raw material and the production process may get hampered, and if it gets hampered, in that case it will be a troublesome situation. So in this case showing it individually is very good, because sundry debtors is coming out or appearing in the balance sheet because of the credit sales. And any funding agency, any source of finance whom we are requesting to provide us the finance, they should be knowing it what is the extent of credit sales, because they would be analyzing that out of the total profits the company is showing in the profit and loss account, how much profit is on cash basis and how much profit is on credit. Because when you prepare the profit and loss account here, say we all know that profit and loss account is a nominal account, and the profit which is shown by the profit and loss account is not the real profit, that is the nominal profit, right. That is the nominal profit, because when you prepare this is the say income statement, we call it as income statement. So this is the income statement. Here we start this income statement, we take here the material, labor and other expenses, right. We take these expenses here, and this time this side we take by sales. And sales, when we take, we never show the sales as how many sales are on cash and how many sales are on credit. For example, we have sold for 100 rupees in the whole of the year, for which we have prepared the balance sheet and this income statement, and out of that 60 rupees is the credit sales and the 40 rupees is the cash sales. It means that finally the profit, net profit before tax, which we are showing here, that out of that profit, the total profit coming here, 60% of the profit is also nominal, that is also on credit. And when you are showing this much of the net profit before tax on the credit, we have not realized it. In that case, it may not be possible that the firm will be able to realize this 100% credit profit, not the profit which is still on credit or which still is yet to be received. Only sales have been made, but the amount has not been received. So out of this, only 40% is the cash profit, 60% is the credit profit. This 60% of the credit profit, whether will be realized or not, that will be the question to be answered in future, and we all understand that there is the something which is known as bad debts, right. So it means out of this 60%, even 10% are the bad debts, and or sometime you have to give the discount or something like that, 10% is the bad debt, or because of other reasons you are not able to recover 5% more for giving the more discount or making provision for the debtors or anything. So it means ultimately what will happen, your profit will come down to 45%. So it means the total profit will be 45% plus 40%, 85%. So the profit which we are showing here as 100%, that will come down to 85%. So to just to know this situation or this particular situation, to deal with this particular situation, what we do is that we show in the balance sheet all the accounts receivables, they are shown category wise, and in the accounts receivables, in Indian situation, in the Indian scenario, out of the total accounts receivables, 50%, around 50% is because of sundry debtors. Half of the accounts receivables are because of sundry debtors. So, we should be knowing that how much sundry debtors are there in a firm, and if you know the extent of sundry debtors, you will be knowing the extent of credit profits, which we have not received yet. They are not actual profit, they are the profit on credit, because sales are still on say credit basis. That is why the sundry debtors are there. So, it means any funding agency or any external stakeholder, maybe the internals also, but largely the external stakeholder, they can get to know that what is the overall financial health of the company. Company is a highly profitable firm, but 80% of the company sales are on credit. So, it means 80% of the profit is also on credit. So, we have to answer this question. That is why in the balance sheet, under the accounts receivable, we do not show all the things together, we segregate it so that we can find out that if you sum it up in this balance sheet, the total accounts receivables amount will become 220. But if you out of this 220 rupees, how much is at sundry debtors? 100. How much is the advanced deposits? That is 20. So, it means these three things make the accounts receivable, and remaining 100 is the other accounts receivable. For example, some say bills, accommodation bills raised by the firm, or maybe sometime we have other kind of, maybe the funds we have given to somebody and we have to receive these funds back. So, they are called as accounts receivables. So, out of this 220, 100 is only sales or sundry debtors, 100 is out of sundry debtors, and 20 are advance deposits. So, other accounts receivables are 100 only. So, it is always better, and we show it in the balance sheet. You might have seen all the balance sheets, or you will see in the balance sheets that we have accounts receivables also, we have sundry debtors also, and we have advance deposits also, or advance payments also. So, but in nutshell, they all are say categorized under the same category, and they are called as accounts receivable, right. Now, we have to understand that this is a very important current asset. Inventory is the one, and after that in terms of liquidity or in terms of lack of liquidity, you can count this accounts receivable. Earlier, as I told you in some previous class, that accounts receivables being included while calculating the quick ratio. When we were calculating the, for knowing the liquidity of the firm, when we were calculating the liquidity, understanding the liquidity position of the firm. So, what we were doing, we are calculating current ratio, quick ratio, and the super quick ratio, right. Current ratio, when we calculate, we take all current assets divided by current liabilities. When we calculate the quick ratio, we take current assets minus inventory and divided by current liabilities, and when you take the quick ratio, we take the cash plus marketable securities divided by current liabilities, right. This ratio is considered as 1.33:1, this ratio is considered as 1:1, and this ratio is considered as 0.5:1, right. Earlier, when there was no liquidity, and when the sundry debtors were also, or accounts receivables were also illiquid like or less liquid like inventory. So, for calculating the current ratio, we were taking all the current assets into account, but for calculating the quick ratio, what we were doing, current assets minus inventory minus accounts receivables, we were subtracting them also, and then we are calling it divided by current liabilities. So, it means that way it was the current ratio, or sorry, quick ratio or the asset test ratio, we call it as asset test ratio also. But now what we are doing, that from the current, now from the, this is the current assets, and what we are doing now, currently when we are calculating the current quick ratio, we are only doing this, that is current assets minus inventory divided by the current liabilities, and that is why now the rule of thumb has also come down, and this rule of thumb is here, this rule of thumb is now, that is 1:1. Earlier it was 1.5:1, because accounts receivables were the part of the quick ratio. Why we have excluded the sundry debtors or maybe the accounts receivables for calculating the quick ratio, and how we consider that accounts receivables are now quickly convertible into cash as compared to inventory, or they are far more better or quickly convertible into cash as compared to inventory. The reason is that as we have discussed in the past also, that we have the bill discounting facility from the banks. If we have sold on the credit, and if the credit period is, for example, 2 months, we are going to realize the payment after 60 days, but after making the sales, 10 days after making the sales, if the firm require the funds, firm knows that the funds from the credit buyers will come, or our say debtors will come after 50 days, because we have given them a credit of 60 days. So what is the way out? They won't make the payment before 60 days, because it is agreed by both the sides that credit period is 60 days. So in that case, firm can go to the bank and firm can get the bills discounted. Those credit sales bills can be got discounted by the firm, and for the time being firm can raise the funds. So whatever the bills are there, so what happens, that normally there are the total sundry creditors or accounts receivables, I would call it as, they are divided into 3 categories, that is A category, B category and C category of the accounts receivables, right. A category of the bills, firms do not want to get discounted from the bank, because getting the bill discounted from the banks is a costly affair, but it helps the firms to raise the funds as and when they are required, and firm is able to make the payment to its different stakeholders when it has to be, and firm is able to avoid the situation of technical insolvency. So that is good, fine, but there is it's a very expensive transaction, because first bank will give you 80% of the bills, so you have to wait for the 20% till the credit period ends and the payment is made by the sundry debtor or the debtor, and once that payment comes, so bank will charge interest for a period of, say in the example we are discussing, for a period of 50 days if the funds are given by the bank. So bank will charge interest at a higher rate for that period of 50 days, and for the amount which is used, that is 80%, which is given to the firm immediately, and apart from that bank charges its own commission and administrative charges also. So it means it is a very expensive affair. So what happens, if there is a good category of the bill, firms do not want to get discounted from the banks, because why to lose money on those accounts receivables which are fully secured, and on those bills the payment on the due dates is certainly, or it is bound to come, it is certain that the payment will be received. C category of the bills are those which are doubtful accounts receivables or sundry debtors, which are quite doubtful, that we have sold to somebody on the credit in the event of maximizing sales, or rather than keeping inventory with us, we passed on that inventory to the some distribution channel on credit, but there is doubt that their overall performance is not good in the past. So there may be possible that out of the 100% credit sales we may recover only 80% or 90%, so there is a possibility that we may lose 10%. So they are the C category of accounts, and B category of accounts are which are having the, you can say, moderate credit rating. They do not default, in the normal case they do not default, they make the payment on the due date. Somehow if there is a very serious issue or some very serious problem, and there is a, say some unforeseen problem faced by the company because of the lack of liquidity, then it may be possible, but normally they are good accounts, not best accounts but good accounts, and they are doubtful accounts, you can say little doubt is attached to this. So what happens, as I told you that A category accounts are very good, company does not want to lose any funds on that, so they do not get these bills discounted from the banks. C category of the bills, banks do not want to discount, because banks are really doubtful about the say realization of the funds on the due date. So it is only ultimately B category of the bills which are discounted by the bank, and firms are also interested to get these bills discounted because they are only in the good category or in the fair category. So that amount is at least available, means sometime if there is a liquidity crunch with the firm, and if they are not having any other source to make the payment to their dues, so and they do not want to say have a situation which is called as technical insolvency of the firm. So in that case what they can do, they can get the bills discounted and go to the bank, get the B categories of the bills discounted from the bank and run the show for the time being, and on the due date when the payment is realized, then the entire adjustment is done. So this is a way out. So why we have done is that while calculating the current ratio, now accounts receivables are removed from the numerator. So only we subtract from the total current assets only inventory for calculating quick ratio, not current, and inventory is the least liquid. You cannot sell the inventory in the market as and when you want it. So, in that case it is the least liquid current asset, but accounts receivables, when they were least liquid, bill discounting facility was not there from the banks. It was a part of the quick it was a part of, say, subtracting from the current assets for calculating the, it was a part of illiquid assets. So, we were subtracting it from the current assets while calculating the quick ratio. But now when this facility is available from the banks, we can get it discounted from the banks. Sometimes now in India, because after 1991 we have got many other sources of working capital finance also. So, in some cases when banks are not able to discount some bills, then these bills can be got discounted from the other sources, and the important source which provides the bill discounting facility is the factoring service. And the factoring services have already started in India, though it is not picking up, but this service has already started in India, and from the factors the bills can be got discounted. What the factors are, what the factoring services are, that I will discuss with you in the sometime later on, but factors is again an alternative if the banks are not providing the liberal working capital. That is the one part. Now in this case we are subtracting it from the current while calculating quick ratio. only inventory is subtracted, not the receivables, because now the receivables have become a little more liquid as compared to the inventory. So, for calculating the current ratio, we take all current assets. For quick ratio, current assets minus inventory, but not minus receivables, and for super quick ratio, so only we take into account the cash plus very short term securities, marketable securities, and then we calculate the liquidity ratio. So, that is one part of the story. In this case, when we are talking about the income statement, so we talked about the concept of the credit profits. That is why the sundry debtors have to be shown separately in the balance sheet, so that anybody outside or any financial institution who wants to analyze the balance sheet of the company, they can easily make out that out of the total accounts receivables, what part is on account of credit sales, how much advance deposits company has made, and remaining how many are the accounts receivables which are not because of the credit sales or not because of the advance deposits. So, in this case we are finding that in Indian scenarios 50% of your accounts receivables are because of sundry debtors, remaining some amount is because of advance deposits, but now we are in a competitive situation. So, even advance deposits are going down over the days, and even you see these credit sales are also going down. When if you analyze the balance sheets of the company, you pick up the balance sheet of any company and you analyze it for the, say, past 2, 3, 4 years in the recent past, if you will see that the accounts receivables are going down, because companies are now, say, minimizing the investment in the credit sales. And since in most of the manufacturing subsectors, I would say subsectors of the manufacturing sector, in most of the sectors we have multinationals performing. So, because of their discipline, because of their excellence, because of their good quality product, and because of their say considering the customer as king, they are able to sell off their product, largely their products on cash. So, they are creating a situation in the market where all the distribution channels have to buy maximum from these companies on cash and then further sell it in the market, and they are even fixing up the target also, that you buy this much number of units from us. If you are our distributor or our dealer, you buy, if you want to do business with us, you have to do it at the excellent level, at the best possible level. So, if you buy from us, we will give you either no credit, or if we will give you the credit, it will be for a minimum period of time and the minimum amount. So, you have to sell this much of units monthly, or maybe quarterly, or maybe bi-monthly in the market, and every month or every 2 months after you will be getting this much of the stock, and you have to sell that stock in the market, and you have to pay us in cash, or sometime not in cash, at least advance checks, so that when we send you the truckload of material immediately we will present your check in the bank and we collect our payment. So, because of this increased competition in the market, and because of the increased financial discipline in the market, and because of the presence of the multinational companies who are very efficient and who do not create a situation of the say buying on credit or selling on the credit. So, in that case the overall accounts receivable situation is improving, is say even sundry debtors are coming down, advance deposits are also coming down, but still they are there, and it will take a time that when it is becoming lowest or the negligible amount, but still in the balance sheets of the firms today accounts receivables exist, sundry debtors exist, advance deposits exist, and we will have to deal with this current asset. But again I would emphasize here again that we will have to make again say optimum investment in the accounts receivables, or rather I would say that it should be the minimum investment in the accounts receivables. If it is possible, try to sell maximum on cash. Try to sell maximum on cash, never to don't encourage the distributors, dealers, or maybe the company directly selling in the market. Not encourage the credit sales. Only in the situation, for example, if you are say having a product or say selling a product in the market which is less sellable in the market, which does not have the say sufficient market existing, or for the products of which company there is no sufficient market, then we are bound to sell on credit. But largely if you want to sell on your product in the market, it has to be on cash, or it is on the cash. For example, you talk about the electronic sector. Electronics, we have largely 3 companies operating in India, good companies operating in India: Samsung, LG and Sony. On the other side, we have the Indian companies also like Videocon, we have Onida, or some other companies also. So for Samsung, if there is a market, why should they sell on credit? And normally they are not selling on the credit. For LG, there is a market, so they are not giving any credit, they are not selling on credit. Sony, there is a market, there is a quality, there is excellence, so they are not selling on credit. In case of Videocon, you will find, in case of Onida, you will find the credit period is very, very high, because their product is not easily acceptable to the people in the market. If somebody has to buy the product on cash, then why not to buy the excellent product? If you are going to buy a product on cash, then why not excellent product? So in some cases, if you analyze the balance sheet of Videocon and Onida, and if you analyze the balance sheet of Samsung and LG, you will find there is a day night difference in the accounts receivables, sundry debtors, maybe sometime advance deposits also, advance payments also, because Videocon has to sell most of their production in the market on credit, otherwise people are not ready to buy that on cash. If you look at the Samsung is a name in the market and people are after their product. So they have made up their goodwill, their brand name in the market, so why they should sell on credit? And if they have to give the credit also, very minimum amount of the credit as incentive to the distributor and dealers just for some period of time, but not for the longer duration. So as this new competition is coming in the market, new discipline is coming in the market, we are aligning Indian market, Indian manufacturers are aligning, or distributors are aligning with the rest of the world. In that case, this market is also moving slowly and steadily towards the perfection, excellence and completion. So in that case, the extent of receivables is going down in the balance sheets of Indian companies also, but still it is sufficient or sufficiently high, and we will have to create a situation where most of the production is going to the market or to the consumers on cash. So if we have to make investment in the accounts receivables, invest minimum, not maximum, and try to sell maximum on cash. So I will stop here, and remaining many other interesting concepts about the management of accounts receivables we will discuss in the next class. Thank you very much.